Why doesn't everyone use it? Which brings us right back to our original question. If this is the most reliable, mathematically proven path to wealth, why doesn't everyone do it? The honest truth? Because it's boring. Because there is absolutely no dopamine hit in watching a number slowly climb over 20 years. It requires admitting you don't need to be smarter than the market, you just need to be vastly more patient than everyone else. So I'll leave you with this thought to mull over. Are you willing to be incredibly bored today so you can be undeniably free tomorrow? Welcome to today's Explainer, where we're looking at the $30,000 secret, buying back your time. Okay, so picture this. Imagine you took just $1,000 back in 1994, parked it in a single, honestly kind of boring investment, and then just walked away. You didn't touch it. You didn't panic when the news got scary. No day trading, no secret apps, nothing. If you had just left it completely alone, that initial $1,000 would be worth over 30 grand today. Sounds almost too good to be true, right? But it's actually entirely real. The math behind this is rock solid. $30,000. And honestly, what's so wild about that number isn't just the sheer growth. It's the fact that this specific path to wealth has been sitting right there in plain sight. It's totally free and available to literally anyone with a standard bank account. But here's the kicker. Less than 1 in 10 people who could have taken advantage of this actually did. It's got to be one of the greatest missed opportunities of our generation. So why doesn't everyone use it? Let's dive right into this, because it brings us to the central mystery of our explainer today. Think about it. If the single best performing, most reliable path to wealth in modern history is this accessible, why isn't everyone jumping on it? If the math wins every single time, what is actively blocking us? Well, to figure that out, we have to realize this isn't actually a finance problem at all. It's a human psychology problem. It's a story about our very own brains going head-to-head with mathematics.
To really ground all this theoretical math in reality, we have to look at how incredibly hard the average person works just to survive. We're talking about the 4:45 a.m. reality. It's that unglamorous, pitch-dark, early morning grind you have to do just to drag yourself out of bed and make a living. Most people out there are putting their bodies and minds on the line day in and day out, and they're exhausted before the sun even comes up.
And when you're working that hard, every single dollar on your paycheck is hard-fought. Protecting that $960 net pay becomes everything. Once you factor in an exhausting 2-week pay period, maybe some overtime, and you're left with a net pay of just $960, the stakes of what you choose to do with whatever tiny bit of savings you have are just incredibly high. It makes total sense that people want to protect it, right? Or on the flip side, that they want to multiply it as fast as humanly possible just to escape that grind. Because we all want to escape that daily grind, most people end up chasing returns. We're looking at the firework versus the oak tree. People want what we'll call the firework. A firework goes up super fast, it's loud, it's flashy, everyone's watching, and it looks great on social media. But give it 4 seconds, it's completely gone, leaving nothing but smoke. Now contrast that with the oak tree. For the first few years, an oak tree barely looks like it's growing at all. It's completely silent. But give it 20 years, it's massive, with these incredibly deep roots you can't even see. The truth is, real, life-changing, generational wealth has never been built like a firework. It's always built like an oak tree. This really brings that exact contrast to life in our everyday choices. On one hand, you have the intense temptation of the firework. The flashy limited time offer, the immediate dopamine hit of buying something new, or jumping on the latest viral trend. On the other hand, you have the quiet, honestly boring discipline of the oak tree. It's sitting in a modest room, meticulously budgeting, and choosing to invest a humble $50. The investment that actually works is almost never exciting enough to go viral. So, why is maintaining that quiet discipline so unbelievably hard? Well, it boils down to a behavioral economics concept known as loss aversion, which basically means feeling the pain of losing money twice as intensely as the pleasure of gaining it. See, your brain was built over hundreds of thousands of years to react to immediate threats. When the market drops 20%, your ancient survival brain doesn't care about long-term spreadsheets. It just screams, "Threat! Run!" Studies show we feel the sting of a loss roughly twice as hard as the joy of a win. So the biggest threat to your wealth isn't actually the stock market. It's you, in a moment of panic, making a split-second decision your future self is going to severely regret.
Okay, so what exactly is this boring, incredibly reliable investment that we shouldn't panic over? It's a broad index fund, like one tracking the S&P 500, which is essentially a basket of roughly 500 of the largest publicly traded companies in America. It's not a single hot stock, it's not a digital coin, and it's definitely not a secret real estate flip. When you put your money here, you aren't gambling on one single company surviving. You're betting on the collective, long-term productivity of the entire American economy. You're basically buying a microscopic slice of Apple, Microsoft, Amazon, and hundreds of other companies, all bundled together into one simple basket.
And the S&P 500 track record, it's just staggering. Since 1957, it has returned an average of about 10% per year, before inflation. Stretched out over decades, this simple, hands-off basket consistently beats professional, actively managed funds. Let that sink in. That means highly paid professionals with massive teams of analysts and expensive software still lose to this boring option over the long run. The people who actually build wealth don't try to outsmart the market. They just don't flinch.
Let's see the growth of $10,000 at 10% over 10, 20, 30, and 40 years. We're talking about what Albert Einstein reportedly called one of the most powerful forces in the universe, compound interest. If you invest $10,000 at a 10% average annual return and just leave it alone, after 10 years, you've got about $26,000. After 20 years, it's $67,000. After 30 years, it hits $174,000. And after 40 years, it's over $450,000.
The crucial takeaway here is the mathematical signature of compounding. It goes flat, 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 and then vertical. Did you catch that? The growth between year 30 and year 40 is actually bigger than the entire first 30 years combined. In those early years, the growth looks totally unremarkable. It almost feels insulting for how little seems to be happening with your money. But that insane vertical leap at the very end is exactly why patience is an absolute superpower.
But surviving that flat part is tough. The tragic reality is that almost nobody has the patience to sit through those early years. Surviving the flat part of compounding requires extreme discipline. It means strict budgeting at the grocery store, tuning out the endless financial noise on the news, and watching your pennies when it feels like your wealth isn't growing at all. This is the exact moment where most people give up, switch their strategies, or panic sell. But it's also exactly where the magic is quietly loading in the background. If you want absolute proof of how essential it is to just sit on your hands and do nothing, listen to this quote. An internal review at Fidelity found that the best performing accounts belonged to people who had forgotten they had the account or had passed away. I mean, wow. They looked at who was actually winning at this game, and it wasn't the day traders tracking charts with 40 browser tabs open. The best performing accounts belonged to people who completely forgot they even had the money, or literally, people who had passed away. Doing absolutely nothing thoroughly outperformed the highly engaged active investors.
You have to think in decades, and remember that dips are discounts. This strategy ultimately demands an entire mindset shift. The people who actually succeed with this method adopt a very specific identity. They think in decades, not days. And when you mentally opt out of the daily noise, something incredible starts to happen. Market dips stop feeling like terrifying emergencies that trigger your loss aversion, and they actually start feeling like discounts. The volatility stops being scary because, hey, you weren't planning to touch that money until next decade anyway. And here's the real emotional core of this entire concept, because the strategy isn't just about getting rich or having some high score in your bank account. It is about avoiding a lifetime of grueling, forced labor. It's about making sure that the young worker out there fixing AC units on a scorching hot roof doesn't have to be the older, exhausted person doing that exact same grueling labor decades later simply because they have no financial safety net. Ultimately, you're buying back your freedom. This is what the money actually buys you. Time, peace of mind, and choices. Someone who invests consistently, even really modest amounts, is building the ultimate option. The option to walk away from a job that drains them. The option to retire on your own timeline instead of relying on someone else's. Checking that account balance later in life isn't about buying a luxury car. It's about the deep security of knowing your investments now make more money than your day job ever did. So why doesn't everyone use it? Which brings us right back to our original question. If this is the most reliable, mathematically proven path to wealth, why doesn't everyone do it? The honest truth? Because it's boring. Because there is absolutely no dopamine hit in watching a number slowly climb over 20 years. It requires admitting you don't need to be smarter than the market, you just need to be vastly more patient than everyone else. So I'll leave you with this thought to mull over. Are you willing to be incredibly bored today so you can be undeniably free tomorrow?